Welcome to the Deep Dive. Today, we're tackling a big one, a question that investors, well, everyone really asks. Can today's data actually predict your long-term investment outcome? Specifically, we're hunting for the single best metric, the one thing you could look at in September 1995, say, to forecast global stock returns over the next 30 years.
Right, and that period, 95 onwards, is just packed with action, isn't it? Bubbles, crashes, weird monetary stuff.
Exactly, a real pressure cooker.
So our mission, as always, is to wade through your sources, find the signal in the noise, and give you that shortcut to really understanding what matters.
Okay, but straight out of the gate, we hit a snag. Data, the global index you wanted to track, something like the Vanguard Total World Stock ETF.
Didn't exist back then.
Nope, not in 95.
So what do we do?
Yeah, the classic inception problem. We needed a reliable stand-in. So we use the MSCI ACWI index. It's a global standard. Goes back to 87.
And has the same basic goal, right? Broad global coverage, weighted by size. Precisely. Market cap weighted, global equities. It's really the best historical proxy we have for what you were looking for.
Okay, proxy sorted. So then the main event, which valuation metric is the fortune teller? What were the candidates?
Well, we looked at the usual suspects. You've got the standard price to earnings, the PE ratio. Everyone knows it.
Sure, seems simple. Price versus what it earns.
Yeah, but the problem is those earnings can bounce around like crazy year to year, makes the ratio noisy, not great for long-term forecasting.
Right, too much static. What else?
Then there's price to book, PB. Used to be huge for value, guys.
Used to be.
Yeah, less so now. Think about it. So much value today is intangible. Brands, software, IP, book value barely captures that. It's looking at the wrong things increasingly.
Okay, so PB is a bit dated. Keep going.
Dividend yield, simple cash return. But, well, companies prefer buybacks now, often. So the yield doesn't tell the whole story about cash return to shareholders anymore.
Makes sense. Buybacks muddy the water.
And finally, price to cash flow, PCF. It's a cleaner measure than PE sometimes, avoids some accounting quirks, but often it's not the main driver people look at, sort of a secondary indicator.
So PE's noisy, PB's outdated, dividend yield is incomplete. Feels that these old tools are struggling. Is there a better way to use earnings, maybe?
Yes. This is where it gets interesting. Enter the KPE ratio, cyclically adjusted price to earnings. You might know it as the Shiller PE.
Shiller PE, right. How does that fix the noise problem?
It's clever, really. Instead of just 1 year of earnings, it uses the average of the last 10 years of real inflation-adjusted earnings.
10 years, okay.
Yeah. It smooths out the business cycle, the booms, the busts, gives you a much more stable kind of underlying earnings power number.
Got it. So let's look at our test period. September 95 to, well, prospectively, September 2025. What did the market actually do?
Over that 30-year stretch, the MSCI ACWI, our proxy, gave roughly an 8.9% nominal compound annual growth rate. So your average return per year.
8.9%. Okay, not bad at all. But what was the CPE back in September 95?
Good question. Estimates put the global CP around 21 back then.
21, yeah. But isn't that pretty high historically? Above average.
It is, yeah, significantly above the long-term average.
And high KP usually means lower returns ahead, right?
Right.
We got 8.9%, which sounds decent. So does this one example just blow up the whole KPE idea?
That's a really sharp point, and it perfectly illustrates the N of one problem. One single 30-year period is just one data point.
Like judging a whole movie based on one scene.
Exactly. It can be totally misleading. To get real answers, you have to look at all the data. Decades of it. Rolling periods. And that's where statistics like R-squared come in.
R-squared. That tells us how much of the future return is actually explained by the metric, right?
Precisely. It measures the predictive power. So when you zoom out and look at all the academic studies...
What do they find? Does one metric consistently win?
Overwhelmingly, yes. Look, PE and PCF show some link. Maybe R-squared is of 0.2 to 0.4. Not terrible, but not amazing.
And PB and dividends?
Much weaker. R-squared often below 0.2. They just don't explain much of the long-term variation.
So the winner is?
The CPE ratio.
Consistently. Across different markets, different long-term periods, like 10 years forward, you typically see R-squared values between 0.40 and 0.60.
Wow. Okay. So significantly better. Why? What makes it so robust?
It's that smoothed 10-year real earnings denominator. It provides a stable anchor. It cuts through the short-term market mania or despair. It's discipline.
A disciplined antidote to our own biases, maybe.
That's a great way to put it. It forces a longer-term perspective.
Hmm.
Now, for you, the listener, this isn't about predicting the market perfectly next month or next year.
Right. It's not a timing tool.
No, it's about setting rational expectations.
Yeah.
If KPE is high, historically, that suggests you should probably expect lower returns going forward than a long-term average. If it's low, maybe expect higher returns.
So it helps frame your strategy, your asset allocation, how much risk you take.
Exactly. It gives you a grounded starting point.
But
But
it's not a crystal ball. Definitely not. There's still a big chunk of future returns, maybe half or more, based on those R-squareds. That's just unpredictable. Wars, pandemics, massive tech shifts. Stuff happens.
unforeseen events will always play a role.
Absolutely. So the KPE is an incredibly useful tool, probably the best single one we have for valuation-based long-term forecasts. But it's a guide, not a guarantee. It's about smart strategy, not short-term bets.
A guide for disciplined decisions. So thinking about all this, what's the key thing that stands out to you? And maybe a final thought for our listeners. As we keep trying to predict these long-term outcomes, could the very act of prediction change how you behave in the market itself? Something to chew on.